you're a first-time buyer in the UK and need to take out a mortgage to purchase that property, you're likely going to have a lot of questions. This video aims to answer the top 10 questions that our clients most frequently ask us when they're looking to take out a mortgage on their first property purchase. How much can I borrow as a first-time buyer with a mortgage? So there are two key assessments that lenders look at when they're determining how much you can borrow. The first you might have heard of before are loan-to-income multiples. So they will apply a maximum multiple of somewhere between 4.5 and 5.5 times your income when determining what you can borrow. So that's total household income. Anything that they will include as per their policy, they will apply that cap as kind of an absolute maximum. The other assessment that they do is an affordability assessment. So they look at, from your household income, what do you jointly net each month. Then they look at your committed outgoings. So it might be credit commitments like personal loans, car leases, credit cards, that kind of thing, any student loans. They'll also look at any dependents you might have, you're paying for the cost of children. They'll then use ONS, Office of National Statistics data, to determine how much it costs to live in your area for that number of people. From there they can work out what your monthly outgoings are likely to be. So look at outgoings versus income, and then work out from there how much you have left over each month to make the mortgage payments. From there they'll kind of work backwards and say, okay, well if you've got this much per month, we think you can afford to borrow this much total. So two key assessments. It all comes down to kind of your personal income, what we can use as to how much you can potentially borrow. What is the minimum deposit required for a first-time buyer mortgage in the UK? Well, this depends entirely on when you're looking to make the application. It changes all the time. For the most part, lenders will want a minimum of a 5% deposit. So that's kind of the least you can get away with. If you're borrowing larger sums, lenders tend to want a bigger deposit. The more you're borrowing, the higher risk it is for them. So they want a bit more buffer between what you're paying for the property and what you're borrowing. So if you're looking to borrow more than $500,000, say, most lenders will want a 10% deposit. Over 750, 15%. And then a lot of lenders over $1 million or $1.5 million will want kind of 25%. So it depends on what you're looking to borrow. However, depending on what schemes are available from particular lenders or the government at the time you're making the application, you might find you're actually able to get away with less than a 5% deposit. As an example, at this point in time in October 2024, 𝗏, who are part of Yorkshire Building Society, have a £5,000 deposit scheme whereby you can buy a property up to £500,000 with as little as £5,000 deposit. So it's just an example of the kind of the schemes that are available there. Best to speak to a broker because these things do kind of come and go, so it depends exactly on when you're looking to make the application as to what might be available to you. How does the first-time buyer mortgage process work? So the first thing I would recommend before you even start going out and looking at properties, or indeed even looking at them on Rightmove or Zoopla, is to work out your budget. The best way to do that is to speak to a mortgage broker who can tell you what you can borrow. So we look at a couple of things, so your household income, your committed outgoings, the level of deposit that you have. From there we can work out what your maximum budget is. So if you want to give us total figures, we can run those numbers and tell you what you can borrow. So that's the first thing, is to get a rough idea from a broker. The second thing is to back that up with approval from a lender. So what we would do after our kind of first call is to arrange for you to get a decision in principle or an agreement in principle. It's the same thing, just different terms. We've actually got another video for that, which I'll link in the description so you can check it out. It goes into a lot more detail. But essentially it's a pre-agreement from a lender that confirms you can borrow up to X amount. And then once you actually found the property, you can then go back to them and say, look, here's the property details. You said I could borrow X. Is that still the case? So it's a good indication that you can personally borrow what you need to. It means that when you go out looking at properties, you've got a good idea of budget. Once you've found a property, then you would make the full mortgage application. So that would involve full underwriting. Underwriting is basically the assessment of your situation. Again, we've got another video on that. It goes into a lot more detail, so I'll link that one as well. The underwriting basically checks that you're good to borrow what they're about to lend you. At the same time, they'll perform a mortgage valuation, so an assessment of the property to make sure that they're happy with that as suitable security for the loan. Once those two pieces are done, you would then have your mortgage offer. Mortgage offer is generally valid for 6 months, which gives you plenty of time to handle the conveyancing or the legal side of the process, and then the lender would be there ready to provide the funds when your solicitor is ready to exchange and complete on the purchase. What's the difference between a fixed rate and a variable rate for first-time buyers? Well, again, I sound like a broken record. There's another video that we've done which goes into a lot more detail on fixed rates and variable rates, which again I will link. But as a kind of rough idea, the clue's in the name. A fixed rate is fixed, it doesn't change, so you know exactly what your rate is for that set period and therefore what your monthly payment's going to be. Makes it nice and easy to budget. You can generally fix a rate for 2, 3, 5 or even 10 years in some cases. And variable rates, on the other hand, are variable, they can change. Some of them, for example, are pegged to the Bank of England base rate, so any change to the Bank of England base rate will change the rate that you pay on your mortgage and therefore the monthly payments. So again, there's pros and cons to both. I'll put the video link in the description so you can check out there a bit more detail. What fees should I expect when buying my first home? So the big one's going to be stamp duty. So if you're paying stamp duty on a property, you need to check that and make sure you've got funds set aside. Other things you're likely to have to pay for are the solicitors. Generally speaking, with solicitors you get what you pay for. You don't want to go super budget because they'll be rubbish and it will be a real headache for you. Things like surveys on the property, depends on the style of property you're buying. Again, we've done a full video on surveys, so I'll link that one as well. Things like mortgage fees. There might be a fee to pay on the mortgage. Most lenders have two sets of products, one with fees and one without fees. The products with fees will have slightly lower rates, the products without fees will have higher rates. So it depends on the amount that you're borrowing as to what is more cost effective. But generally speaking, they're between $1,000 and $1,500, and you have the option to add that onto the loan, so you don't necessarily need that as cash available to you. But those are kind of a rough idea of what cost you might be expected to pay as a first-time buyer. How do I improve my chances of getting a mortgage as a first-time buyer? The key thing here, and I always tell my clients this, is to line up your credit. So make sure that everything is registered in the same place. And we deal with a lot of clients that are maybe renting a property and they still have bank statements going to their parents' address, their family home. They have their link to the electoral roll at the property they lived at when they were at uni. All this kind of stuff makes for quite a muddled credit search. So if you can put everything together in the place that you're currently living, that will make everything a lot easier and a lot smoother. So that would be my kind of number one tip. The other thing is kind of preparing as much as you can in advance. So we mentioned speaking to your broker to find out your budget, applying for decision in principle or agreement in principle from a lender, so you've got a bit of paper showing that you can borrow what you need to. Even things like speaking with solicitors to get an idea of who you'd like to use. You don't need to instruct them or pay them anything, but starting to do that research so that you're as prepared as possible. So when you do find something you like, you can make an offer and make a strong case for yourself that you're set up and ready to go. What is a mortgage in principle, and do I need one as a first-time buyer? So we've done another video on this, I'll link it in the description, but mortgage in principle essentially is a pre-agreement from the lender confirming that you can borrow what you need to. The advantage of doing that up front is you obviously give yourself peace of mind that you've got an option. You're also going to find that the agents will look to book viewings a bit more receptive to you. They know that you're good to go. And finally, when you actually come to making offers, you don't necessarily need one, but it just strengthens your offer. If you can consider you've got a buyer that you're competing against which has their finances in place, and you've just you've done a bit of research online but you haven't actually approached a lender to get your decision in principle, you could be offering the same thing and one buyer looks a lot stronger than the others. So important to get that done ahead of time so that you put yourself in the best possible position. How does my credit score affect my mortgage application as a first-time buyer? So with credit scoring, lenders generally apply a kind of yes-no approach. So either your credit score is strong enough for them to lend you money or it's not. However, there are some instances where they might be satisfied your credit score is good enough to lend you at, let's say for example, 25% deposit, but not at 10% deposit. So if you're putting in a larger deposit, you're lower risk to them. So they might say, okay, your credit score is not good enough to borrow at 90% with the 10% deposit, but if we scale that back and you're able to put in a 25% deposit, it's less risk for us, so we're willing to take that chance. So in that way, your credit score can impact the amount you can borrow and the size of the deposit that you need to put in. How long does it take to get a mortgage as a first-time buyer? Well, generally speaking, the average time from mortgage application to mortgage offer is about 2 weeks. So once we've got all the documents in hand and all the information we need, we can apply to that lender. The information will go then through to an underwriter who will assess the case. At the same time, they'll instruct a valuation to make sure that they're happy with the property that you're buying. Once all that information is collated, they've asked any additional questions they might need to kind of satisfy them, give them comfort that you're a suitable borrower. They'll then produce the mortgage offer. And as I said, the average time is about 2 weeks. More and more lenders are automating systems so they can actually verify your income and your outgoings using credit scoring, credit reporting. So the processing time is actually a lot quicker. If they're able to do that and they do an automated valuation on the property, you can actually find that the mortgage offer is produced the same day as the application. So progress. All depends on the situation as to how they assess it and therefore the time, but average is about 2 weeks. What documents do I need to apply for a mortgage as a first-time buyer? So the core things you'll need will be proof of ID, proof of address, proof of outgoing, so bank statements, and evidence of income. So if you're employed, that would be pay slips. If you're employed with additional variable elements of pay like bonuses or commissions, we need the pay slips to show those pieces. If you're self-employed, most lenders want a 2-year track record. So if you're a sole trader, that would be your profit from self-employment on your tax calculations. If you are a limited company, they might want the tax calculations plus your company accounts. There are some lenders who will look at your 1 year's accounts only, so potential sort of advantages there. So basically it depends on how you're employed as to what documents we need, but all the rest is kind of standard. It's stuff that we ask for up front, so you kind of gather those documents ahead of getting an improvement in principle, so it's not going to then slow you down when you actually find a property and want to make a full application. You make sure that everything's lined up, in place and ready to go. So those are the top 10 questions that our first-time buyers typically ask us when they're looking to take out a mortgage. There are a lot more videos with a lot more detail on each of those aspects, so feel free to have a look through the channel, dig out anything that's relevant. If there's anything you missed, any questions you want answering, then please do drop us a comment, or equally feel free to get in touch and we'll discuss your own personal circumstances in a bit more detail.